Okay, one reason I really like coming in, I like to fill in on this show, because Minnesota Live breaks down the headlines that you report during 5 Eyewitness News mornings and that you always post on social media.
So Tyler Shipper is an economics professor at University of St. Thomas. Back to talk about a bounce back of the stock market and other headlines. Professor, good to see you.
Happy to be here and glad to talk about good news.
Right?
Wow.
Right?
Usually it's the bad news I get to be here to break down.
And we will talk about some of those.
There's always a mixed bag.
Sure, but it has been pretty remarkable to see where the market has gone and when it was not looking good there for a while.
Right. So since about mid-April when we had that Liberation Day and stocks dropped over a 3-day period, since then they're back up about 30%. It seems like every day you turn on the news, it's been incremental, a little bit here, a little bit there, and very upward progression.
Is this why a lot of investors today, like when it goes down, don't panic? I mean, you know, when you hear, don't panic and sell everything, just wait it out.
This is going to be one of those points that people point to that, you know, panic selling or even panic buying in some cases can be really detrimental. It's that long-term, put little bits of money in, cost averaging is what they'll call that then is. And the longer you're in the market, generally, the better you're going to do.
Okay.
But no one can really pinpoint why it is doing well because there's been a lot of factors that don't make the overall economy look that great, yet the markets are still doing well.
Yeah, I think this is one of the things that I'm struggling with is that this upward trajectory of the stock market is mostly just that really bad things aren't happening. So instead of really, really high tariffs, we're kind of settling into higher tariffs, but not that kind of worst case scenario. And that's kind of had a feedback loop to how some people feel about the economy. So
Because, so much of it is like emotional. It's an emotional reaction.
Consumer sentiment's bounced back a little bit from April, but we're seeing this split. So there's a Good Morning Consultant poll that kind of showed that people with over $100,000, people with money in the stock market, are starting to feel better about the economy. People with less than $50,000, we haven't seen that bounce back. And so it kind of depends on where you're at and what kind of finances you had going into the Trump administration.
Okay, I'm glad that you mentioned the tariffs because that's a big thing. I saw a headline this morning about the European tariffs settling on 15%. Is that where do we stand? Because I'm finding it a little bit hard to figure out, are they happening? When are they happening? And then every country or region has a different deal.
Yeah, it's a little bit like a hamster wheel. And I think that makes it really hard for people to, there's changing headlines, changing deadlines, trade deals, not a trade deal. So there have been some what we'll call successes for the UK, Japan, and Europe. But I think the overall tendency here is that we're seeing tariffs that are going to be in that kind of 10 to 20% range.
Okay.
So that's consistent with what then candidate Trump kind of promised during the campaign, that we were going to see these across the board tariffs. And that's looking like even with deals like with the EU or like with Japan, we're seeing those much higher tariff rates that are anywhere from 5 to 6 times higher than they were before the Trump administration. But not that worst case scenario. And that's part of the reason why these are being celebrated by some of our trading partners as deals.
And so have the tariffs had a big impact on the labor market?
Yeah, so not on the labor market so much. I want to say that even with prices where we're expected to see some of this effect, it's starting to trickle into the data. That in the latest CPI report, we did see some jump ups in prices for types of goods that are more likely to be imported, things like apparel and furniture and small electronics.
Okay.
But for the labor market, it kind of just keeps chugging along. We're still creating about 130,000 jobs a month, but it depends again on who you are, because we're not seeing large-scale layoffs, but we're also not seeing firms scramble to hire people. So if you're already out of a job, people saying, oh, 130,000 sounds great, or the unemployment rate is low at 4.1%, we're seeing people that don't have jobs take longer to find that next job or that first job.
Okay, that makes sense. All right, so economy, I mean, when we talk about it kind of looking okay, then everyone obsesses over interest rates. If you have a 3% interest rate, don't mean to brag, but I do, you're like, I'm not moving because the interest rates are higher. And everyone's just like waiting to hear the Fed drop the rates. Do you think this is going to happen?
I just had a visceral reaction to what you just said there.
3% hurt you?
I have a 3% interest rate. We bought a new house. We're closing on Friday.
No.
And it's going to be like 7%.
Yeah. And that is a huge difference when you talk about over the life of a mortgage.
If I hadn't dealt with my 9-year-old throwing a tantrum that shook my small home, I would be so much more triggered by this. But I'm going to imagine that I can go to one corner of my basement now. He can go to the other corner of our much larger house, and I'm not going to be able to hear him. And
That's a
that's
good
bringing
frame.
me calm, and I'm okay with the fact that I'm giving up my 3%.
The mental gymnastics that you just did there, I think, was really
Yeah,
very
it was.
impressive.
And it happened like this.
Yeah.
I'm on fire this morning with trying to put economics in perspective. But, I mean, the headlines here are going to be about the Trump administration trying to pressure the Federal Reserve to lower interest rates.
Okay.
And the trick here is, I want lower interest rates, you want lower interest rates, but we are worried that if interest rates get lowered too quickly, before some of this inflationary pressure from tariffs gets resolved, it might reignite inflation. And so the Federal Reserve is kind of taking this wait and see approach as long as the wheels haven't fallen off in the labor market.
Okay.
So I think they're still coming later this year. We'll probably see a rate cut or two. But you're going to also see a lot of headlines about that pressure from the White House against the Federal Reserve and that tension there.
Well, if you're of a certain age, like my dad, you love to always be like, this is still the best interest rates you could
Right,
Our
because
first
they were
house in
paying-
St. Paul was 18%.
Yeah. No, it's true, and that's
So-
good perspective. But
And
Sorry about
millennials will
that.
say, and your house prices were significantly
Yeah.
lower.
Okay,
so
that-
you can afford a
you
higher
could buy a
interest
house for
rate.
$50,000.
That's a
too.
good point.
We showed some video of back-to-school shopping. I do want to address that. Is there anything that you're seeing as far as trends of back-to-school shopping, if things are going to cost more, or if big retailers are trying to dial it back the other direction?
You know, this has been one of the interesting things with tariffs is that a lot of those back-to-school supplies would be coming from abroad and be subject to higher prices. But retailers did a couple things. One is they brought in a bunch of inventory. I don't know if they were thinking this far out, but maybe to some extent. And they're concerned about how consumers are going to react. That 50% or 50K and below part of retail, they're thinking, I can't afford to pay more. And so big retailers might be thinking, we can't actually pass all of these prices on to consumers. And that's, I think, maybe why we don't see this as much yet. Now, the longer those tariffs stay in place, think Halloween or Christmas time,
Yep.
this is going to continue to bleed into prices because it has to. We're not just going to see firms be less profitable in perpetuity.
They won't absorb it. Okay.
And China's the last one that we're really kind of tracking. Some of the other ones have been worked out as far as the big economies.
Actually, so I think this is a big area of uncertainty is that still Mexico, Canada,
Yep.
and China, that
Yep.
those ones are still up in the air, and that's a much bigger chunk of our trade than the UK, Japan, and Europe.
True.
Interesting.
Professor, thanks for stopping by. Good to
Thanks,
see
Tyler.
you.
Thanks for having me.
Congratulations on that new house.
I know, that's very, very exciting. Sorry about the interest rate.
Yeah.